We are live.
Welcome, everybody. I'm Ben Wright with the Instant Group, and welcome to Using Data to Select and Open Profitable Centers in North America. And when we say centers, we of course mean flexible workspaces. So let's go to the next. So just a little bit about Instant. Instant is the largest global marketplace for flexible workspace. Flexible office operators work with us to open new centers, grow revenue, and improve their margins. Let's go to the next. So, really excited to be presenting here with some really smart folks. I mean, our goal today is to talk about trends in flexible workspace. James Rankin, our head of research and insights, and have heard from him before. The purpose of this is how to use data, the data that James's team puts out into the market, and those trends to your advantage in opening profitable new centers. We'll also cover trends in costs and competition and demand, and discuss how to find supply and demand imbalances. What that really means is finding locations that lease up faster and make you more money. We're going to go through a couple markets too, which will be really interesting. Looking at Miami and Austin, two markets that I think a lot of operators are interested in. So in addition to James Rankin, we're joined by Evan Tyroller, who's our Director of Partnerships and the leader of Instant's Location Services practice. Evan was formerly Portfolio Director for the Mid-Atlantic region for WeWork and has worked with PwC and Cushman. I'm Ben Wright. I'm the Executive Director of Partnerships for the Instant Group. Know many of you on the phone. I'm the MC today. A few ground rules. As you have questions, please use the Q&A function down at the bottom of your screen. I'll be monitoring that, and we'll answer questions really in the context of the presentation or at the end. But please, we want this to be very interactive. We're also, going to be doing a number of polls, and we'll share all the results of polls. So we really encourage you to respond. The reason why is we'll all learn something from this, including us, which is great. So with that said, I'm going to go ahead and hand this to James Rankin, who's going to take us through the market data portion of our session. Take it away, James.
Thanks. Yeah, thanks, Ben. So if we move on to the next slide, I think this is just a quick summary of the topics that we're going to cover off today. I'm here to give you a warm welcome, but also introduce sort of just the high-level trends that we're seeing across the US and North American market. My job within the Instant Group, and I've been with the company for about 6 years, is to use the knowledge and the data that we have throughout our business to really try and help inform the industry. We started out doing a lot with the operator and providers of flexible workspace, 6+ years ago when I joined, and that continues. But it's been an interesting journey. Over the last couple of years, we've seen a lot more sort of questions come in and requirements for sort of insight into flex from asset owners who I think are becoming more savvy. They're becoming more interested in what's happening within the industry. And then, as Ben's mentioned, I'll pass over to Evan and Ben, and they'll talk you through a couple of the hot markets that we see right now. And despite some of the challenges, within the North American market, there are undoubtedly some really hot, fantastic markets for future growth or further growth. And then I think Ben's going to talk around sort of the management agreement considerations, which again is a big question, particularly with the new interest from asset owners and investors into the community. So if you move on and get into the topic, I should say, if you've got questions, please do ask, put them into the chat. I think Ben's going to be, as he said, the sort of the compere or the master of ceremonies, and will be feeding those back to me throughout. So please do ask questions as we go. So for the last 6 years, as I say, since joining the industry, we've, as Instant, have always been in a position to talk about the fact that flexible workspace as an industry is seeing growth, outperforming the traditional sector and driving greater cash flow. I think all those things remain true today, But based on sort of market sentiment and the conversations that I'm having with operators and providers of space and the recent research that we've been doing, that there's no doubt that for many of those providing space, the market conditions I think are tougher, and ultimately profits are being squeezed across the board. As I say, that's not just something that we are seeing in the flexible workspace industry. I think the fact that an increasing number of asset owners, and we were with I was with a huge investor yesterday afternoon, who really, and they openly admitted that 2 years ago they would not have been having that conversation with us. We would have not been sat in front of a number of their fund managers, trying to help them understand the opportunities that flexible workspace brings to their businesses. But so what I'm saying there is, while we are seeing some challenges in flex, again, the conditions are far, far tougher in the traditional sector. Within the North American market, feedback from operators, has indicated that I think the biggest challenge compared to sort of pre-COVID is the fact that the cost of doing business, frankly, has increased substantially. On top of that, the market's now more competitive. I think expectations from customers, both new and old, are now higher than they've ever been. And these are things that we're all experiencing in our day-to-day businesses, and just means that we need to be smarter and more on the ball than we've ever been before. On a positive note, within North America, inquiry volumes, demand volumes as a whole are reported to be slowly increasing compared to pre-COVID, again, based on the research that we have. And profitability has increased, albeit only by a little. And I think this is likely due to the sort of the greater actually maturity of most businesses, which naturally, as occupancy rates sort of increase and businesses mature, that profitability comes in, which is a great thing to see. These challenges, though, aren't, they're not unique to North America. I was at a conference in Europe last week, and the sentiment about the current conditions was very much the same, with most operators, I think, feeling the pinch and finding it more difficult to maintain previous levels of profitability. I think there are positives, though. One is the future expectation. Expectations for growth remain very high within both the asset owner landlord sector, but also from the operator community, with growth being one thing that the majority of operators are expecting to see in the future, but also the continuation of demand that will help drive that growth. I think that the second is that the challenges in the traditional sector are even higher, as I've said, with expectations from new customers at an all-time high in that side of the industry, and demand volumes dropping quite sharply. That represents both, I think, challenges, but also opportunity, depending on your sort of position in the market. I think what this means for us as an industry is we need to be better informed, more now so than sort of ever before, using both our experience that we've all gained, but also the available market data, some of which I'll take you through to help inform our decision making, either when it comes to expansion or just to understand the performance of a local market close to an existing location, and make sure that we are matching market conditions or hopefully outperforming, and being able to make those informed decisions. So if we move on to the next slide, that'd be great, Whitney. So I mentioned in the previous slide that demand for flexible space has grown compared to pre-COVID levels. Across North America, demand within our business is up nearly 60%. So inquiries are up nearly 60% compared to 2019. And I think within the US, that figure's up 25%. So very positive numbers there. The challenge, I think, is ultimately this trend is not consistent. The market remains fluid. And while markets such as New York are still recovering, other cities such as Miami, Mexico, and Austin are seeing unparalleled levels of demand. There's no doubt that unfortunately, if we look at the US in isolation at a national level, demand has probably rebounded slower than maybe in some other global markets. But I'd also suggest that this market remains one of the most underdeveloped from a flexible workspace perspective when you look at sort of percentage of flexible stock in the market versus traditional. So expansion into satellite towns and smaller cities is still very much in its infancy from what we're seeing. And I think there appears to be, some major opportunities within both the US and North America for future expansion. Looking ahead, I don't think there's an easy single solution when it comes to demand for flexible space. It will continue to recover at varying levels across the US, but I would say that at least there are clear opportunities for growth out there, some of which we'll talk about later on in the session, and these will remain. As an industry, I think we just need to be smarter when it comes to looking at the opportunities, and also realize that sometimes markets that generate the highest baseline rents aren't always the most the most opportunistic. We have to again look outside the box a little bit. So if we move on to the next slide, it's all well and good me talking to you about what we're seeing, but I'd love to get thoughts and feedback as from the audience and from you listening. Ultimately, we've got a number of polls, as Ben mentioned, and this is one of them. So I'd love you to take part. The question here is, in markets where you operate, what do you expect from a demand perspective next year? So if we can run that poll, that'd be brilliant. Not sure. Whitney, can you run the poll? Possible?
Yes, the poll is running and the answers are coming in.
I can see it now.
Yes.
Perfect. So I think on average, what I think is positive is there's a couple of don't knows, but broadly speaking, we are, as an audience, positive about future demand. I suspect that if we'd answered this question again in 2018, then rising by 10% or more would have been a higher percentage. But overall, I think a positive sentiment from the audience, and expectations for while maybe not robust growth, steady and sustainable growth in the years ahead. Brilliant. Thank you for that. As Ben said, we'll share all these results with everyone listening as we go through. Great. So if we can move on to the next slide, that'd be great, Whitney.
All right. Now sharing the results of this first poll.
Brilliant. Thanks, Whitney. Yeah, if we can move on to the next slide, that'd be great. So I think looking at demand's only one part of the puzzle. Ultimately, strong demand means nothing if supply of the market outmatches it. And probably positively for most of you on the call, supply of new flexible space appears to have not kept pace with demand since COVID, certainly in the US. But again, that is a global trend. In fact, at a total market level, you could say supply of flexible spaces remain relatively flat for the last 4 years, or at least only seen sort of minor increases at a national and regional level. Part of this, I think, is due to operators, both big and small, with sort of weaker financial models being forced to close. Unfortunately, we have seen a lot of that, although it's not reported hugely in the media. We also see many smaller spaces struggling to sort of maintain cash flow during the last 3 years. Again, flown under the radar when you've got sort of giants like WeWork making frontline headlines. I think the challenge, as we see it, is the drive for quality from occupiers, and certainly a lack of what I would call quality space or high quality space outside of the major city centres in the US right now. Some of you on the call may argue with that perspective, but that's what I'm seeing. And I think while markets such as New York, LA, Chicago, as examples, still see sort of landlords looking to support assets with increased cash flow, it's in the smaller markets across the US that ultimately remain undersupplied. And I think the ability to build viable business models and understand rental potentials remains probably more of an art form than a science right now. Although increasing data, by the likes of ourselves and others in the industry is now changing that. And I hope that at least we will sort of help unlock local investment into what I think to be a much needed area of the industry. I think we've got a chance now to look at another poll. If Whitney, we can go to the next one and launch the poll. Again, love the opportunity to hear from you, in particular to understand if you expect your business to grow or change from a locations perspective over the coming years, certainly over the sort of the next year. Really keen to see what your thoughts are there. When I've asked this question over the last couple of years, there has been a very positive response about expansion, and I think that's what we're seeing here. Nearly between 60 and 70% of those on the call looking to add locations. I think another sort of 20% potentially looking to both open and closed, probably depending on performance. But again, very positive sort of sentiment from you all on the call in terms of the expectation for future expansion and further growth within the industry and within your businesses specifically over the coming years, which is great to see.
There is something I'd call out in these results, which is the both answer. I think for a long time, there were many operators who just thought of their business as growing. That was pre-COVID. But we're seeing the rise of what we call portfolio optimization. And I think Evan sees that with a number of the operators that he works with. But I think that's an interesting trend here is the both.
Yeah, the realization that, to your point, optimization needs to happen. Some locations have probably been open for a number of years and it are in need of change. Again, that's not something that is unique to the US audience. Although I would say that I think the US audience is probably more maybe switched on or aware of this trend. So it seems to be slightly more prevalent here than in Europe, for example. Great, thanks, Whitney. If we can move on to the next slide, that'd be brilliant. So supply and demand imbalances sort of alongside a lack of confidence from operators is creating price volatility in the market. And I think certainly in a number of businesses hurting margins within North America. Average inflation has been at around sort of 5% annually over the last sort of few years. I think it's slightly lower in the last couple and higher in others, but on average it's around 5%. But what we've not seen from a flexible rates perspective is an increase by the same level, certainly not across the board. Again, this isn't just a US problem. In Europe last week, I asked an audience over 400 operators how many had been able to fully pass on cost increases to their customers in the last year. And just 1% were able to indicate that had been something that had been possible within their businesses, which for me is quite a startling statistic. But broadly speaking, you can see from the table that in those markets where demand has seen strong growth and supply has remained relatively stable, rates have increased. But in markets where competition remains high, maybe unsurprisingly, occupancy is maybe below ideal levels. The differentiation between the product or the offering is maybe slightly less clear to occupiers and customers. I think it's been limited when it comes to rate increases, and certainly when you consider the cost increases that we've seen across the industry, that's a challenge. All of these factors, impact rates, etc., are a good indicator and should be used to both, from my perspective, benchmark business performance, but also think about future opportunity. And that's something that we can certainly support with using the data within the business. Let's say my big takeaway from the conference I attended last week was that while cost increases had not been fully passed on, most providers actually were in a stronger market position than they recognised. And those that brought in significant rate increases, well, maybe not finding those conversations easy, had seen limited turnover in regard to their customers, and those that had left, they'd managed to replace within 6 months. So again, it's having that visibility of what's happening across your peers and your competitors, and being able to put yourself in a position of power to react. So if we move on to the next slide, this I will touch on very quickly. I think one of the things that we're seeing within the industry, as I say, when it comes to sort of imbalance, is a challenge around sort of growing those desk revenues. When we asked what's causing that challenge to providers and operators such as yourself, the biggest response there was actually a feeling of a lack of demand in the market, so getting more leads through. But I think equally, that there is a consciousness that we need to be competitive. We need to maybe not value our services to the full extent, or we have concerns around what our competitors may undercut us, which again can be solved by having some visibility of true market conditions and trading conditions. So if we move on to the final slide of my segment, one thing that for me is always really important is to think about why ultimately our customers choose Spaces over others. Everyone's got the majority of people have got other options when it comes to workspace. What I think was really interesting when we asked the US customer base or about this, they found that productivity, due to the different types of environments within flexible workspace within the US, was really the driving factor. And what's interesting for me is that isn't a trend that we saw across all other global markets. So I think one thing that we should be particularly, or you should be particularly proud and positive on, is the fact that your Spaces are helping drive productivity, and they are really delivering value alongside the softer things such as staff and community, which are obviously equally as important. So I think we've got a couple more polls to run, which Evan, I don't know if you want to take on, depending on time.
Sure, we can Ben.
Let's go ahead and run.
Sure.
Let's go ahead and run these. And this one is very much about how you view success. And we asked this question of all the operators that we work with. And so it's good to get feedback. It used to be, in the early days of Flex, I'm solving the future of work, right? Now it's a little bit more, call it financially motivated. Okay, so profitability is king. Okay, Whitney, I believe there's one more after this. And while we're doing this, if you've got questions for James, go ahead and, from what you saw, I think it's incredibly valuable to get for America's base, that's US, Canada, and Mexico attendees that we have. It's great to get a global perspective, but if you've got questions, please put them in the Q&A. All right. And then the last poll of this section. Outstanding. Great. Thanks. I think we've only got 51% participation on this one. Let's see if we can't get a few new joiners on this.
There you go. It's creeping up there, Ben.
There we go. Good. Okay. Fantastic. Great. So Whitney, we can close this poll and move to the next slide. So I'll be monitoring questions as we go, or we're going to shift gears a little bit into, okay, you've seen the data. Let's actually talk about sourcing new locations. And to talk about that, I'm going to pass it over to Evan Tyroller, who directs our location services practice at the Incident Group in the Americas. Evan, take it away.
Thank you. And Whitney, we can continue with the next slide here. So thanks, Ben and James. And, as the industry continues to evolve, we're currently working with about 12 operators, helping them source new locations throughout North America. And as we partner with these operators, we're recognizing some of the key challenges for sourcing new locations, including accessing the right information. Is a broker really the best advisor to help us with these transactions? How to best leverage market intelligence and data to make the right decisions. So here you can see that first off, the landlords are really not investing high amount of TI money into co-working. There's more and more second generation co-working space becoming available. And at the Instant Group, we're actively tracking closed centers as we delist those from the global marketplace. So a lot of the operators we're talking to are looking for second generation space, and it helps provide a unique opportunity for a landlord and operator to reduce the friction as part of the deal negotiation. Without the need for major build-out costs, landlords are more willing to consider alternative deals when revisiting co-working for their asset. Operators really need to educate and work with their landlord partners to perform detailed financial analysis and underwriting to really determine the potential costs and revenue projections for management agreements or rev shares and non-traditional lease deals. When we move into the timing of new locations with future demand, we know that data can really help reduce risk. Operators can reduce risk by conducting comprehensive market research to truly understand pricing and the demand for co-working spaces in a specific market or submarket. On the demand side, just because you open it doesn't mean that members are going to show up and start buying desks. So ensuring that the operators conduct a comprehensive understanding of the demand and supply metrics is instrumental to sourcing the best new locations and achieving alignment with your landlord partners. Lastly, landlords are not really willing to share risk, and most operators are not willing to sign leases. And landlords are hesitant to consider deal structures other than leases. So banks and landlords are having challenges valuing management agreements, and the industry is changing with time. We believe that more owners will become receptive to these alternative deal structures. And as we continue on to the next slide, we'll kind of walk you through how James shared instance tracking from the industry at a market level. And then the next few slides, we're going to give you a deeper dive into the markets and really show you how the Instant Group is leveraging our data to support our operator partners when they're searching for new locations. So we're going to focus on Austin and Miami. And on this next slide here, you'll see that at the Instant Group, with more than 7.3 million visitors across a constellation of websites, we've done 25,000 Flex transactions in a year. Our global marketplace is a remarkable database and a great resource into how the Flex industry is really performing. With this data, we're able to see impressive insights into the industry, and we've developed a set of extraordinary dashboards, including the one here on our demand side, to help our operator partners really make better informed decisions regarding new locations. When you're not only just tracking transacted desks right through the Instant platform, but we're really looking at inquiries for space, which is what James talked about, to really see where demand is going. The inquiries to our various marketplaces help us really understand the trends within a particular market. As you can see here on the middle graph on the bottom, over the past 3 years, we've been tracking at 58% increase in inquiries across the greater Austin market since 2021. And that's the red number there. When we're looking at the yellow percentage there, the 48% increase in demand just for the defined submarket within downtown Austin. And in 2023, 64% of the total inquiries that have come to the Instant platform for Greater Austin were focused just on this small submarket of downtown Austin. The demand data is very valuable to an operator, and as referenced earlier, can help build a business case to the landlord partner. And as we kind of get a better idea of demand, let's take a quick look at pricing in Miami on the next slide. And with regards to pricing, it's really critical that operators conduct thorough market research to better understand market dynamics before sourcing new locations. And as Ben mentioned earlier, I spent 4 years at WeWork running the Mid-Atlantic portfolio for portfolio strategy and sales. And at the peak, I had 27 locations and about 20,000 desks that I was responsible for between Philly, DC, Maryland, and Virginia. And we were always working to really adjust pricing. And we really didn't have the best metrics to do that. And even WeWork didn't. And we were working on Secret Shopper and other methods of doing that research. But really, had I known that this data set was available, it would have been instrumental and extremely valuable to us in our ability to kind of readjust pricing in a way where we can do it based upon market demand and additional transactions. And so when operators or brokers are conducting Secret Shoppers, they're really only hearing retail rates, but our database is really allowing us to understand what transacted pricing means. So that's critical for pro forma underwriting and really understanding how to make the best informed decisions. As you can see on the graph in the bottom right, within this radius of Coconut Grove within Miami, which are the gray bars, compared to the broader Miami market, which are the green bars, we're seeing a 15% desk price premium for 1 to 2 desks, 20% premium for 3 to 9 desks, and a 10% premium for 10 to 25 desks. Tracking this data and sharing these trends with our operator partners allows us to better advise them and allow them to understand how a submarket is performing to help them make the best informed decision. When you take supply and demand and pricing into account, you're able to have a much clearer picture regarding the trends in a given market, which will support the decisions operators are having with their landlords about getting deals done, and also discussing alternative deal structures, such as management agreements. And if we move into the next slide, management agreements, we're really seeing competing interests. As most of our landlords and operators know, there's a disconnect right now as it relates to how we're getting transactions done. Landlords and operators are not aligned on the preferred deal structure. So why should landlords really consider management agreements? First, with regards to revenue potential, co-working often generates higher rental income per square foot, and thus a higher revenue opportunity for the landlord. When we think about flexibility and adaptability, this really does allow for quicker adjustments to changing market conditions without having a long-term lease in place. And lastly, with reduced risk exposure, traditionally the landlord bears the risks of vacancies and fluctuations in the market. With a management agreement, there is shared risk, and identifying the right operator and helping reduce the risk associated, given the reduction in leasing volume across most markets, does help. So if you'd like to learn more about management agreements and the Instant Group's location services platform, after our next poll, there'll be a QR code where you can inquire about some additional resources that we have available from our team. And we'll move over to our next poll question now. So here is our poll question 5. Who is the most valuable advisor you have for new locations? And I'll hand it back to Ben.
Seven. I'm glued to the screen just to get a sense for how people will answer this. It's great. Okay, very good. Thanks, Whitney. All right, let's go to the next slide. Okay, so there's the QR code. And so what I'd like to do now, I mean, I'll kind of summarize a little bit what I heard. If we go to the next slide, that'll be the summary slide. What you heard from James was that it is a, particularly in the Americas, more so than the rest of the world, it is a harder time to do business maybe than pre-COVID, certainly not than during COVID. This has surprised a lot of our operator partners who came out of COVID with so much energy. Demand itself, I think, is certainly regional in nature. You saw some places like Mexico City that are just off the charts, or Miami or Austin. You saw some that are a little bit more tempered, like New York. You know, there are different tools and ways to identify new locations, but we talked about supply demand imbalances being the best way, and the idea being, how do you identify a market where there's more demand than supply, which can really drive your lease up, which candidly drives your performance like nothing else. And we also gave you a little bit of data about you know, the value prop that members are looking for. We learned that from our client side of our business, and so on and so forth. You heard from Evan, really looking at two, I'd call it stereotypical markets, right? Miami and Austin. Both are fast growing, but not every market, or not every submarket. So Evan honed in on Coconut Grove, for example, as a great submarket. That's really key when you're choosing locations. And then lastly, we talked about kind of the biggest trend. We estimate 90+% of all new co-working or flex operations will sign management agreements this year, but they're not easy and they're different from a landlord's perspective. So that's what we covered. With that, I'm going to open the floor up to questions. We've got a couple already, but keep them coming. So first question comes from Rebecca Green. So when do you anticipate the flex office market will mature sufficiently for managed agreements to become more acceptable? especially given the current preference for leases among landlords. What key milestones do you envision? So this is going to be one. I'll kick it off. This is a great question, Rebecca. Thanks for answering it. This doesn't feel like a maturity issue to me. This actually feels like a valuation issue to me, meaning a landlord, the way his or her building is valued is based on not just cash flow, but the length of the lease and the credit of the underlying tenant. So, the credit of some of the co-working operators are maybe not as stable as some others, for one, and two, a management agreement being so much shorter term than a lease. These create cash flow benefits to landlords, but not valuation benefits. So until that math changes, I think we're going to continue to see challenges there. Now, obviously, vacancy helps a lot of things, right? So as landlords have vacancy in their buildings, they're going to be more willing to try different things. So, Evan, I'll kick it to you for your answer. It's more of a when. When do you see landlords' attitudes changing according, for management agreements, or are there specific kinds of landlords that you're seeing are more open to management agreements today?
So Ben, I think I agree with everything you've said here, and I think from a timing perspective, I would argue between the next 6, 12, and 18 months, we're going to start seeing more landlords receptive to this as they're receiving the inquiries for this. And additionally, as additional supply comes on the market, specifically with the WeWork supply that's inevitably coming back to the market, I think landlords are going to be in a position where they're going to have to become more flexible in the deal terms that they're willing to accept for transactions. So I think we've got some time, but I think we're well positioned as an industry to educate and inform the landlords about the benefits of a shared type of agreement like this.
I would just jump in and add, I mean, from what I'm seeing, it depends a little bit on the type of the landlord or asset owner. If it's a family-owned asset who don't have specific timescales, going back to your point, Ben, around sort of resale, then they're already, some are open to management agreements, and we are seeing that take place. If it's a fund that is looking to potentially trade that asset in the next 5, 6 years or less, then there are, I think, structural issues when it comes to the valuation, as you've called out. And actually, very few assets have traded with management agreements in place, which makes modeling what that looks like very difficult. To what you said, though, Evan, I mean, I would say that over the next 12 months, we will see significant devaluation of assets. Public opinion and investment opinion is already showing that. When you look at publicly traded portfolios, they are 40 to 50% down on pre-COVID levels. A lot of them are anyway, if not more. And that may well give an indication of, I think that's quite an extreme indication, but it gives an indication of what the future may hold for certain asset owners, and therefore will force them to look at new options.
Right, great. So one other, I think one other question I would put to these two is James and Evan is, and we've got one that we'll talk about now. Are we going to share the presentation later? Absolutely. We'll send out a version of the presentation to the folks that signed up. The other question I've got has to do with construction costs. It's a little bit out there. But one of the things we're seeing, Evan, you had made the point about landlords not investing as much in co-working. That's true, but the cost of building out co-working has gone up too. So what kind of construction costs, even for second generation spaces, are you seeing? And is there a willingness from landlords to even provide that kind of gap, conversion costs when it comes to construction?
So we recently worked with an operator, and we were talking to the landlord, and the consensus was somewhere between $60 and $80 a square foot to effectively refresh the space and rebrand it, and that in that scenario, they were going to require a lease and some additional lease security, given those costs. With regards to management agreement for that same building, they were willing to offer no more than $20 to $25 a foot for TI. So I think that is kind of showing you exactly how landlords are valuing the difference between the deal structures at this point.
Absolutely. Yeah, thanks for that. Okay, great. Well, I think, in terms of this, I think I'll wrap it up by just really thanking our presenters. I think James, great. Thank you so much for your global perspective. I think Evan, thanks for your perspective working in the Americas to help operators locate new locations. I want to thank everybody that attended, and we'll send this out a little bit later. But hope everybody has a great day and that it was a valuable session in your business.
Thanks all.
Thanks, everybody.